Saba Capital is about to blow up the entire UK investment trust sector. This is a £267 billion market that's been operating the same way for decades. But over the next few months, things could change drastically. The FT reported last week that Boaz Weinstein is launching the UK's first ETF, specifically designed to target and profit from the discounts in investment trusts. Hello, and welcome back to another episode of GRC in Focus. I'm your host, Asad. On the docket today, Man Group's unfolding crisis, the UK investment trust discount problem, and finally, the shadow banking risk that I think every board should be monitoring now. But before I start, I want to be very clear about something. This is not about me pointing fingers or trying to be sensationalist. This is about identifying what's not working and helping boards and compliance teams understand how they can better support their businesses. So let's dive in. Well, you've probably seen the headlines the past week that Man Group, the world's largest listed hedge fund, they conducted a 3-month emergency review of their quantitative strategies. But their conclusion was nothing is broken, just unfavorable market conditions. I have to say, from a governance perspective, I find this a bit concerning. Let me explain why. As a board member, one of your primary responsibilities is strategic oversight, which means you're not just, rubber stamping management proposals, but you are critically evaluating whether the firm's strategy remains viable, especially in changing market conditions. Now, if I was on that board, I would have immediately asked, hold on, are we saying that our strategies aren't broken? Or are we saying that admitting they are broken is too scary to contemplate? Because, here's what we actually know. Shares are down 36% in a year. They've had 3 consecutive years of underperformance in their flagship strategies. Wealthy clients are pulling their money, and former employees are publicly saying that they think Man Group should just focus on being a great hedge fund instead of, trying to diversify into everything. To me, these are clear warning signs that something within their broader strategic framework has broken down. Now, I haven't verified this, but just reading from public sources, it seems the board's response was nothing to see here, folks. Again, I don't know this for a fact, but, and this is a big but, if the board just accepted management's assessment that the problem is purely, unfavorable trading environment, rather than questioning, whether the fundamental strategy itself needs to be recalibrated, I see this as a failure of constructive challenge at the board level. I say this because, when you look at the UK Corporate Governance Code, it explicitly requires boards to provide effective challenge to management. Now, this doesn't mean being antagonistic, but it does require the board asking some of those difficult questions. Questions like, if market conditions have fundamentally changed, why are we maintaining strategies designed for, different market conditions? What is our plan if these unfavorable conditions were to continue for the next 2 or 3 years? And are we being honest with shareholders about, the viability of our business model? I think the moment performance problems became clear, the board should have called for an emergency session with one agenda item. Are we in a crisis? And if not, why not? Now, maybe they did, who knows? But, sometimes board, they tend to wait because they don't want to overreact. But I would argue that overreacting to, a false alarm is probably better than underreacting to a real crisis. I think what they should have done is commission an independent strategic review. Now, I think they did commission a review. What I am stressing here is they should have commissioned an independent review. And I mean truly independent, not the consultants who helped you with your last 5 acquisitions, or the advisor who plays golf with your CEO. I'm talking about someone who will tell you the truth, even when it's uncomfortable. And as part of this review, I would ask for very clear deliverables on, whether this is a temporary market dislocation or a regime change. What's the probability that our strategies work again? What's our strategic alternatives? And I would want to understand what, for example, what are comparable firms doing? But perhaps more importantly, what are our clients saying? I think the main questions that needs to be answered here. Question number one, do we actually understand what's happening? And look, I am very serious about this. If I am on your board and you're telling me unfavorable market conditions, then I'm going to ask you to quantify that. Show me the specific market characteristics that changed, show me the math. Show me why you think this is temporary versus structural. Now, if management can't answer this question backed by quantitative analysis, this tells me that they probably don't know what's wrong. They don't have the full picture, and they're just guessing and hoping. Question two: does our board have the expertise to challenge management's assessment? You see, sometimes board don't necessarily have the deep expertise in the businesses that they oversee. Now, maybe that's okay for a stable business, but when things go sideways, that's a disaster. In Man's case, their CEO, Robin grew, he came up through compliance, not trading. Just to be very clear, I don't see any issue with that. There's nothing wrong with compliance backgrounds. In fact, I come from a compliance background myself. And I would argue that this allows Robin to bring a different dynamic to the boardroom. What's important, though, is that the board collectively has sufficient expertise to effectively challenge the assessment that nothing is broken. A well-functioning board means, they have the right mix of skill to oversee the business. Now, in Man's case, Man Group is a quant fund, so their entire competitive advantage is mathematical modeling of markets. So I would want to understand how many people on that board actually have deep trading experience, and, can they challenge assumptions about, for example, model parameters, regime change probabilities, correlation structures? Do they understand regime changes in markets? And, can they understand whether management is being realistic or defensive? And look, if the answer is not really, then I think you have a governance gap. Management could literally tell you anything, right? So what do you do? Well, I think for a start, you bring in outside experts, experts who can brief the board. I'm not talking about management's chosen experts. I'm talking about your experts, people who can translate the technical stuff and tell you if management's analysis actually makes sense. And then question three, what's our strategic response going to be? And this is where I think some people disagree with Man's current course. Man Group decided to diversify by acquiring a bunch of different firms. So they acquired Numeric for long only. They acquired Alto for real assets. They acquired Varagon and Barding Hill for private credit. Look, I don't think there's anything wrong with diversification per se. Diversification is not inherently bad, but you do need to ask, are we diversifying because, that's the right strategic move? Or are we diversifying because, we don't want to admit that our core business might be obsolete? Now, in Man's case, not everyone thinks that, what they're doing is the right play. Some of the former employees have actually been quite vocal, and they think that, the firm should just focus on being a great hedge fund. To be honest, I think that's probably sensible advice. But it does mean that, they would have to admit that their current approach is not working, and then, think about fundamentally changing that. Now, you don't want to be like the guy who, his house is on fire, but, he decides that the solution is to buy more houses. Maybe the original house was the problem. I think for any board, this is a real dilemma. Do you double down on your core competence, or do you diversify away from underperforming businesses? Now, either choice can be defensible, but what's not defensible is the lack of a clear strategic direction. So as a Ned, I would be asking, what is our theory of value creation here? Because, if our quant strategies are structurally challenged, maybe acquiring our way out of this is a solution, but obviously that depends on our ability to pick the right targets in the first place. Of course, the other challenge for Man Group is they are publicly listed, and so this prevents them from making the necessary long-term changes. As we know, public boards, they typically face pressure for quarterly performance, which can conflict with the multi-year investment horizons that's typically needed in order to transform a business. So as a director, you've got to be very honest about, whether your existing governance structure enables the time horizon that your strategy actually needs in order to crystallize. Because if your business model needs 5 years to prove itself, but your shareholders have quarterly redemption rights, that's a fundamental mismatch that I think the board needs to address first. So if you are a compliance officer at a firm facing similar challenges, you've got some work to do. First, you need to look at your disclosures. The compliance team need to ensure that the business is being transparent with shareholders about the challenges. So you need to think if your risk disclosures are adequate. You need to think about, whether you're meeting your continuous disclosure obligations, because when performance deteriorates dramatically, disclosure obligations change. You can't just say, look, past performance is not indicative of future results and then call it a day. The FCA expects clear, fair, and not misleading communications. Now, is saying nothing is broken when your stock is down 36% and clients are fleeing, is that misleading? What do you think? So you need to ensure risk disclosures in offering documents are correct and comprehensive. Performance advertising isn't cherry picking the good stuff. Client communications are balanced and realistic. There's no selective disclosure to some clients, but not others. And then I would say, secondly, you need to look at your risk culture. This is softer, but equally important. Because, when a firm is underperforming, you get pressure. Pressure to take more risk, pressure to show good numbers, pressure to not raise concerns. Your job is to watch for these warning signs, like, are people afraid to escalate problems? Are risk limits being tested more frequently? Are people, especially people with long tenure, are they leaving? If yes to any of these, you need to escalate to the board, and not in 3 months, immediately. Okay. And then thirdly, be realistic. Look, I've been in compliance long enough to know that, sometimes your job is to be the adult in the room, the people who says, look, I know we don't want to talk about this, but we do need to talk about it. If you're sitting in compliance watching your firm insist nothing's broken while, everything's clearly broken, then you have an obligation to escalate. Document your concerns, put them in writing, and send them to the audit committee, to the risk committee, or whoever will listen. Will this make you popular? No. Will it protect the firm and possibly save your career when things blow up? I think yes. I think the governance principles here apply across industries. First, boards must maintain independence of judgment. Don't just accept management's narrative without testing it. So if management says nothing is broken, your job is to verify that assessment independently. Second, boards need relevant expertise. Look, you can't provide effective oversight if you don't understand the business that you are overseeing. Technical complexity is not an excuse for lax governance and poor supervision. And then thirdly, increasingly, strategy and risks are becoming inseparable. Man Group's strategic review, I think, should have included a comprehensive risk assessment. So if your strategies work in some market environments, but they are failing in others, that's a risk that the board needs to understand and manage. And then fourth, transparency matters. Look, when performance deteriorates, shareholders, they deserve clear explanations. And so boards need to ensure that management is being honest about the challenges rather than, hiding behind technical jargon. Now, let me be very clear. I am not suggesting that Man Group's board has violated any regulations or, they've failed in their legal duties. What I am highlighting is that technical compliance with governance codes is not sufficient. Effective governance requires judgment, courage, and a willingness to challenge comfortable narratives. I think the broader lesson here for boards is this. When your business model shows sustained underperformance, staying the course is a choice, not a default, okay? And choices require justification. Now, the board's role is to ensure that justification is robust, realistic, and in shareholders' best interest. All right, let's talk about the problem with UK investment trusts. I see an agency problem here. So Saba Capital is about to blow up the entire UK investment trust sector. This is a £267 billion market that's been operating the same way for decades. But over the next few months, things could change drastically. The FT reported last week that Boaz Weinstein is launching the UK's first ETF, specifically designed to target and profit from the discounts in investment trusts. So why does this matter? Well, for a start, boards of investment trusts are about to learn what happens when you leave £38 billion lying on the table in the age of activist hedge funds. For context, the UK has 317 investment trusts worth a collective £267 billion. These are closed-end funds that trade on the stock exchange. Your pension probably, owns some. Your ISAs definitely does. And right now, they are trading at an average discount of 14.2% to their NAV. So technically, you could buy £100 worth of assets for £85.8. Now, in any efficient market, that gap would close instantly through arbitrage, but not in the UK investment trust sector. In fact, that discount has been in double digits since, for the past 2 years. Why? Because investment trusts don't have this sort of, inbuilt arbitrage mechanism. ETFs have this. They can create or redeem shares to keep the price in line with NAV, but investment trusts can't. They are effectively closed-end, so you get this permanent discount that effectively enriches managers while screwing shareholders. Now, enter Boaz Weinstein. He's the founder and chief investment officer of Saba Capital, and he's launching an assault on the entire UK investment trust sector. The press hasn't been very flattering about him. They're calling him all sorts: greedy intruder, vulture, etc., etc. But you know what I call him? Smart. Last year, Weinstein launched an aggressive campaign to seize control of 7 trusts, but the establishment rallied against him. Shareholders overwhelmingly rejected his attempt to get his nominees elected to their boards. And they thought they'd won. They thought they'd managed to protect their little kingdom. But unfortunately for them, you don't need to control the board if you can control the economics. And you don't need permission if you have leverage. And that's exactly what this new ETF gives Weinstein. It's a tool to accumulate positions across the entire sector and then force change whether boards like it or not. The Saba Capital's UCITS ETF will be domiciled in Ireland, and what it's going to do is basically build stakes and voting rights across multiple trusts. This should allow it to push for change, and then it should be able to benefit from any narrowing of the discount. Richard Stone, who is the CEO of the Association of Investment Companies, that's the trade body for these trusts, I think he tried to sound diplomatic about it when he said, this is more of a traditional activist model which seeks to profit from narrowing the discount, unlike their previous attempt to take control. I think what he's really trying to say here is, look, we try to stop him from taking our boards, but we can't stop him from taking our lunch money. And what's important to note here is, despite his initial failed campaign, the Middlefield Canadian Income Trust has already announced plans to become an ETF, what the FD calls an industry first. And other trusts have also agreed to let some investors exit at prices close to NAV. So you can see that even with his his initial unsuccessful campaign, he's managed to force some changes. But Weinstein is not new to this game. Weinstein already runs the Saba closed-end ETF funds in the US, where he's got about $322 million in AUM. So I suspect he's going to try to replicate his playbook here. Kenneth Lamont from Morningstar told the FD that there's potentially a structural issue with the market given these persistent discounts. He said that the Saba ETF is a tool that has been built specifically to tackle that. But then he goes on to add that he's not sure whether Europe is ready for something like this. Look, Europe may or may not be ready for American-style financial aggression. But I think that's beyond the point. But what's really interesting is, when Saba ETF launches, it's going to start buying shares in investment trusts that are trading at the biggest discounts. So let's just war game this for potential scenarios. Let's say, when they launch, the ETF starts targeting trusts that are trading at a 20% discount. So the ETF starts with accumulating small positions, so maybe 5%, and then they move on to 10%, and then, maybe they get to 15% of the shares. Now they've got voting power, which means they can propose resolutions, they can demand buybacks, maybe they can push for tender offers, maybe they can even call for liquidation or even, force conversion to an open-ended structure. And what's interesting is every one of these actions will either narrow or eliminate the discount. Now, can boards stop it? Well, I suppose they could always, maybe threaten a poison pill, or maybe even more drastic measures, like, for example, they could make it less attractive for Saba to continue onto this campaign. Maybe they could delay or derail the activist campaign by perhaps leveraging their relationships with more, larger and long-term investors. They can go on this maybe, charm offensive where they try to rally these investors to vote against Saba's resolutions by portraying Saba as a short-term hedge fund seeking a quick profit rather than, a partner in the fund's long-term success. And, maybe they could argue that a liquidation would destroy long-term value, or that a conversion would change the fund's mandate, and this would hurt its performance in the long term. But either way, I think, these boards are about to learn what American capitalism looks like. Now, you have to ask, why didn't they do anything about this? How did we end up in this situation in the first place? Look at the incentives. If you're running an investment trust, you get paid based on assets under management, right? So whether these assets trade at par or at 20% discount doesn't really affect your fee. So why would you care? Why would you do anything to close that discount if it might threaten your control? That's classic principal agent problem. The agents in this case, the boards and the managers, they have very different interests from the principals, being the shareholders. Now, in America, the way you solve this is with hostile takeovers and activist investors. But in the UK, we didn't do anything to solve this. In fact, we allowed this to fester for years. When you look at the scale of this value destruction, the weighted average discount of 14.2% on 267 billion pounds, that's approximately 38 billion pounds in value that's just sitting there, trapped by structural inefficiency and board intransigence. That's real money that belongs to shareholders, but it's being held hostage by an outdated structure. Now, some will argue that investment trusts, they have certain advantages, like, for example, they can take illiquid positions, they can gear up, they don't face redemption pressure. All true, but none of that justifies a permanent 14.2% discount. I mean, think about it. If these advantages were worth it, the market would have priced them in, right? But the market is telling you that those advantages aren't worth 14.2%. You know, the market is telling you that the structure is broken. Weinstein is going through Ireland for a UCITS structure, which means he will have access to the entire European market. I would say that's a very smart move. He's not just targeting UK trusts. He's actually building a pan-European war machine. And every share that, he will buy, it's a vote. And every vote is pressure. Every bit of pressure will force boards to confront a simple question. Narrow the discount voluntarily or have it narrowed for you. Some boards, I suspect, they will cave in early, so they will announce buybacks or maybe tender offers to prevent Saba from accumulating bigger positions. Others will probably dig in, and I suspect they are the ones that will get destroyed, because this is what happens when you dig in against an activist with permanent capital and a proven playbook. They keep buying. They will rally other shareholders. They will call for extraordinary general meetings. They will propose resolutions. They will make your life miserable until you either capitulate or you get replaced. So I'm looking at this from a fund manager's perspective, and what I see is real opportunity. I think if you are running money in the UK, you need to think about how you can front run Weinstein. So I would say maybe buy the trust with the biggest discounts now before his ETF launches, so that when he starts accumulating and forcing change, you will benefit from the discount narrowing. And who knows, maybe some UK managers might even take this a step further. They might even launch their own activist campaign, because I think Weinstein he's shown the way. I'm guessing this is not taboo anymore. If anything, I would say this is probably open season now, but the clock is ticking. And I would say maybe boards probably have about 6 months before this ETF starts hunting. So 6 months for UK boards to figure out how they're going to adapt. Because if they don't, well, this is how I see it. Weinstein will probably launch with maybe, let's say, 100 million. So not much, but it's enough to buy maybe 1 to 2% positions in dozens of trusts. Enough to be annoying, but not threatening. But then the first trust cracks. And before you know, the ETF is at 300 million. So now it can buy 5% positions. Now it's not just annoying, it's dangerous. And then more trusts crack. So more discounts narrow, more capital flows in. And within 2 to 3 years, this ETF is now at 1 billion in AUM. So now it's the largest shareholder in dozens of trusts, and it's dictating terms. And the entire sector has been transformed. So average discounts have narrowed from 14% to 5%. I did the maths. It's about 24 billion pounds in value unlocked. And Weinstein? Well, he's collecting management fees and performance fees. So, that's 15 million pounds a year plus 50 million pounds in performance fees. Not bad, right? Now, some will say that Weinstein is a villain, but is he? I mean, who allowed 38 billion pounds in value to be trapped? And who collected fees while shareholders suffered? And more importantly, who allowed this inefficiency to persist? I think Weinstein is just the market doing what markets do best. That's, finding inefficiency and destroying it, and finding value and unlocking it. And yes, he's going to get rich doing it, because that's how capitalism works, right? I mean, you get rewarded for solving problems that either others can't, or, they won't solve. But look, ready or not, here he comes, because, the market doesn't care what you want. The market cares what you deliver. And the reality is that UK investment trusts haven't been delivering lately. Now, from a governance perspective, this raises some really interesting questions. Firstly, disclosure. So as Weinstein's ETF starts to accumulate stakes, trusts will need to monitor and disclose significant shareholdings. Boards need to start tracking and preparing for potential activism. And then secondly, shareholder engagement. So boards need to proactively engage with major shareholders, including activist funds, to understand concerns and try to explore solutions before positions become entrenched. Boards also need to think about conflicts of interest, because, board members need to examine whether their positions create conflicts between personal interests and shareholder interests. If you are opposing discount narrowing mechanisms that would benefit shareholders but cost you your board position, that's a conflict that you need to manage. Boards also need to think about fiduciary duties. So directors have legal duties to act in companies' best interests. Now, when 14.2% of value is trapped, boards need to demonstrate that, they are fulfilling their duties. The argument that, we've always done it this way, that's not a fiduciary defense. Now, some of the investment trust boards, they have long-serving directors who have deep relationships with management. And look, whilst I can understand that this creates comfort and this creates continuity, I think it also creates groupthink, and this can give rise to resistance to necessary change. So that's why you need strong independent directors who can bring diversity of perspective, because, if your board has had the same board members for the past 10 years and they all come from very similar backgrounds, well, you're unlikely to have the sort of, fresh thinking that you need to address any structural problem. Now, from a risk management perspective, I think boards need to ask two questions. Firstly, what is the strategic risk if our structure becomes obsolete compared to ETFs and open-ended funds? And then secondly, what is the governance risk if, we are seen as prioritizing management interest over shareholders? Look, the solution doesn't have to be an immediate conversion to an ETF structure. But I think boards need to demonstrate that they are actively managing the discount issue rather than, simply accepting it. I think the bottom line is this: boards exist to represent shareholders' interests. But when those interests are clearly not being served, as evidenced by this persistent double-digit discounts, I think boards need to act. And if they don't act voluntarily, activists will force action. That's not a failure of the market. That's just, the market working as designed. Okay, let's move on to the last item on the docket for today: shadow banking. So, two seemingly healthy companies collapsed within weeks of each other, catching investors completely off guard. Now, if you didn't have time to catch the headline, TLDR, First Brand had up to $10 million in debt and off-balance sheet financing that no one knew about. And Tricolor had AAA rated bonds that are now basically worthless. So what went wrong? Asset managers have issued $380 billion in CLOs, collateralized loan obligations, this year alone. And increasingly, this debt is finding its way into pension funds, insurance policies, and retail investment accounts. Let me start with Tricolor. They specialized in subprime auto loans, so, lending money to people with bad credit to buy used cars. Subprime auto loans, they are at the very bottom of the barrel in consumer credit. These are loans to people who can't get loans anywhere else. But Wall Street loves subprime auto loans. Why? Because you can then, package them into bonds and get them rated and then sell them to yield hungry investors. So this is 2007 all over again, except instead of houses, it's cars. Tricolor was a master at this game. They would originate loans to subprime borrowers, and then they would bundle them into asset-backed securities, and then they would get pristine ratings from the agencies and sell them to investors. Lenders provided roughly $2 billion against portfolios of auto loans originated by Tricolor. $2 billion backed by loans to people who by definition can't pay back loans. And who was buying these bonds? Hedge funds, specialist credit funds, and a number of large banks, including JP Morgan. So they are exposed to losses on hundreds of millions of dollars worth of auto loans. I mean, JP Morgan, one of the most sophisticated financial institutions in the world, and they are holding the bag on subprime auto loans from a company that's now being investigated for fraud. Now, the obvious question is, how on earth did JP Morgan miss this? I think the answer is quite simply the entire system has been designed to obscure risk, not to reveal it. Rating agencies, they get paid by issuers, not investors. So, they have every incentive to give high ratings. Banks that underwrite these deals, they tend to collect fees and then they will sell the risk to someone else. They don't really care if the loans are garbage. And then finally, you have the investors who, I guess, they are so desperate for yield in this low rate environment that they will basically buy anything that will give them a return. So it's a circle where everyone knows the game is rigged, but as long as the music keeps playing, everyone just keeps dancing until the music stops. For Tricolor, the music stopped in September when they missed an interest payment. Some lenders are now attempting to seize vehicles. I mean, literally trying to repossess cars from subprime borrowers to recover their money. Well, I say good luck to that, because these cars, they are probably worth only half what was loaned against them. But Tricolor is small potatoes compared to First Brands. First Brands Group is an auto parts supplier that managed to accumulate, wait for it, up to $10 billion in debt and off-balance sheet financing. $10 billion. And just weeks ago, their bankers at Jefferies were marketing a new $6 billion loan deal, reassuring investors that the company had nearly $1 billion in cash. First Brands junior debt is now trading at just cents on the dollar. So they've gone from marketing $6 billion in new loans to pennies on the dollar in just a matter of weeks. And how does a company go from raising billions to bankruptcy in weeks? Well, the answer is shadow banking, specifically something called invoice factoring or receivables financing. Invoice factoring is when a company sells its invoices, so money that customers owe it, to a financial firm for immediate cash. So let's say, for example, Tesla owes you $100 million payable in 90 days. You sell that invoice to a factor for $95 million today. So the factor collects from Tesla, and then hopefully they make $5 million. Pretty straightforward, right? Except First Brands took it to an extreme. So they were factoring everything. So every invoice, every receivable, every IOU. And they were doing it with multiple factors who didn't even know about each other. Lenders had very poor visibility into the more opaque invoice-backed financing, and they were concerned that they lacked visibility about the scale of the off-balance sheet financing, meaning First Brands was borrowing from, say, Peter to pay Paul, but neither Peter nor Paul knew about the other. Millennium Management, the same Millennium that's now paying Steve Scher $100 million, by the way, and an investment unit of Jefferies, They were the ones who provided some of this financing to First Brands. Now, these are supposedly sophisticated investors, right? And still, they got completely blindsided. Apparently, First Brands always offered the highest yields and they always had capacity to do more. So there was no limit. I think that's a red flag when a company always has capacity to borrow more at the highest yields. It's not because they are great credit. It's probably because, they're running a Ponzi scheme. So they're using new money to repay off old money. But investors just kept lending. I think this is the core problem with shadow banking. There's so much money around looking for yield that lending standards just go out of the window altogether. And due diligence just becomes this checkbox exercise, and risk management just becomes a joke. Deloitte reckons that semi-liquid funds, so where money can be withdrawn periodically and with limits, they could attract up to $4 trillion by 2030. And 40% of it would be from retail investors. I mean, I'm guessing that's, people's retirement account and college fund. And I'm guessing that regular people, they probably have no idea they are invested in subprime auto loans and invoice factoring schemes. And this is a real danger because, it's not just that Tricolor and First Brands have failed. It's that their debt has been sliced and diced and repackaged and distributed throughout the entire financial system. It's in the CLOs, which, are in mutual funds, which are in, 401ks in the US, in ISAs here in the UK. It's in insurance company portfolios that back your life insurance. And this is exactly what happened back in 2008 with subprime mortgages. The losses weren't that big in absolute terms, to be honest. I mean, maybe 500 billion in actual defaults. But those losses were so widely distributed, they were so cleverly hidden, it was impossible to track that nobody trusted anybody. And the entire financial system froze because no one quite knew who was exposed to what. I think we have to pause and ask, are we setting up for the same thing? Except this time it's not just mortgages, it's auto loans, it's invoice factoring, it's private credit, it's CLOs, and maybe some exotic instruments that didn't even exist back in 2008. The problem is, post 2008, regulators wanted to strengthen the banking system by shifting borrowing away from regulated banks into other parts of the financial system. And what they ended up doing was basically they moved risk from regulated banks that you could actually monitor to shadow banks that you can't. So they've basically moved it from institutions that had to hold capital to institutions that don't. So effectively, what they've done is they've moved it from transparent public markets to opaque private markets. You could argue that they didn't eliminate the risk. They've actually helped to hide it even better. And now it's starting to blow up. And I find this very concerning. The speed of these collapses, it's frightening. First Brands went from marketing $6 billion in new loans to trading at cents on the dollar in weeks. Tricolor went from AAA ratings to fraud investigation in a matter of weeks. Now, in the old days, corporate failures, they would take months, maybe even years. There were warning signs, like, for example, credit downgrades that would happen gradually. And so investors actually had time to adjust. But in the shadow banking world, everything is binary, right? You are either fine or you're dead. So there's no middle ground. Why? Because shadow banking runs on confidence, and confidence can evaporate instantly. The moment lenders suspect something's wrong, they pull their lines. The moment factors think they might not get paid, they will stop advancing. And the moment investors smell trouble, they run for the exits. And because everything is interconnected, one failure can trigger a cascade. So Tricolor fails, so investors look more carefully at other auto lenders. And when they find problems, they will pull back. So credit tightens. Companies can't roll over their debt. It's contagion. Investors are already combing through their portfolios to confirm that other companies they had lent to didn't face similar troubles, and they are asking for more detailed questions before underwriting new deals, which means the credit markets could start to freeze. Now, when trillion-dollar markets lose confidence, credit disappears. Does anyone even know how big this, shadow banking system really is? I mean, is it $1.5 trillion? Is it 3? Is it 5? I mean, what is it exactly? Look, back in 2008, at least we knew where the banks were, right? We knew their balance sheets, we knew their exposures, we knew their capital ratios. So, for example, when Bear Stearns failed, we could trace the connections, right? But with shadow banking, we are flying blind. These are private funds making private loans with private terms. So, there's no central registry. Now, I know some people will argue that, this is actually safer than traditional banking because, private credit funds, they have lower leverage than banks, and investors lock up money for longer, which reduces run risk. I'm not disputing this. This is true, but I think this is irrelevant. Why? Because yes, private credit funds have less leverage than banks, but the companies that they lend to, they are leveraged to the hilt, right? First Brands had 10 billion in debt. That's leverage. Yes, investors lock up money for longer, but semi-liquid funds, they are growing rapidly. And these allow periodic withdrawals. Now, when everyone wants out at once, semi-liquid, they become illiquid real fast. Understand this. Shadow banking has all the risks of traditional banking, credit risk, liquidity risk, correlation risk, but none of the safeguards, right? So no deposit insurance, no lender of last resort, no capital requirements, no supervision, right? So it's banking without any safety net. And when this blows up, the victims this time, they will be regular people who thought they were being conservative, who thought they were safe, who had no idea they were lending money to subprime borrowers and Ponzi schemes. And the irony here is this time the banks are actually in decent shape, so they are less likely to suffer. Now, let's think about what will trigger the full crisis. What will make this go from isolated failures to systemic collapse? I don't know. It could be anything. It could be a recession that causes corporate defaults to spike. It could be a rate shock that makes refinancing impossible. Or maybe it's just a fraud scandal that destroys confidence. But I think the trigger doesn't matter. What matters is that the system is primed to blow. You've got about $3 trillion in private credit that no one really understands. You've got borrowers like First Brands who are using every trick in the book to hide their true leverage. And you've got rating agencies who are just rubber stamping garbage as AAA. And finally, you've got investors who are so desperate for yield that, they'll buy anything. So I would say we've got all the ingredients for a disaster. So if you are a fund manager, my advice to you would be, look, you need to get out of anything that you don't understand, because if you can't trace the risk, it means you can't manage the risk. Look, it's that simple. If you don't know where the bodies are buried, you need to assume that they are buried under your feet. So you need to go and check your exposure to private credit, to CLOs, and I would say, anything that sounds exotic or promises yields that seems too good to be true, because I think they are too good to be true. So for the companies who are relying on this shadow banking for financing, look, when this market freezes, which it will, you need to understand that you won't be able to roll over your debt and you won't be able to access credit. So my advice to you is, please start building cash reserves now and start diversifying your funding sources. That's all I have for today. If you found this content helpful, please share it with your network. I will see you next week. Until then, stay compliant.